Friday morning. Good to have you with us. Let's talk business. We'll get to markets in a second. First, some good news. The Reserve Bank leaving that key repo rate unchanged at that 14-year high of 8.25%. Yes, it's still bad news that it's so high, but it could very well have been worse. Consumers escaping being squeezed with another rates hike. The bank cautioning, though, there are still factors posing a risk to inflation. Earlier this week, inflation increased marginally to 4.8% in August from 4.7%. So it went up 0.7%. Now, a lot of that to do with the fuel inflation, which I'm afraid is going to get worse as well come October. So what are some of the issues around a possible increase of the interest rates in months to come, in years to come? Let's find out. Economist Dr Azar Jammine, always very kind with his time on a Friday morning. Doctor, good to have you with us. Can we talk about if you thought this was going to stay in place? Did you think there was going to be a slight increase? Because we were seeing that two members were actually opting for a 25 basis points increase. We got away with this one.
We did get away with this one, and to some extent we were fortunate to get away with it because it's quite clear that there are some potential new inflationary influences that may well require interest rates to be increased still further. The first of these you've mentioned is petrol prices and diesel prices are going to go up sharply yet again in the beginning of October, and that's going to push the inflation rate up quite sharply over the next couple of months. Secondly, we know from the Reserve Bank's own research that there are usually knock-on pass-through effects from higher fuel prices into higher food prices. So the food inflation rate, which has come down very sharply most recently, may well turn around and start going up again. And one aspect that the Reserve Bank highlighted in this regard that is a new dynamic is the onset of the El Nino phenomenon globally affecting weather patterns. And that could result in a drought and unduly hot climate over the summer season that could create food shortages. And the third factor here is that internationally, central banks led by the United States have been warning that the increase in interest rates that they have seen need not be over, and that there is a significant possibility that they may well also have to raise interest rates again when they meet, typically in November.
Yeah, well, I can see that the gold price already this morning, Doctor, is taking a little bit of a hit with what is happening over in the United States. We'll get to the currencies and commodities in a second. I'm curious to get your thoughts. We also heard from the Reserve Bank governor yesterday, Lesetja Kganyago, saying that one of the elements, one of the aspects that they take into account is how consumers are coping. It's not everything they take into account, but he made the point that right now these interest rates are not good for those people who are borrowing money. But let's not forget there is the other side of this coin that is actually very good for those who are saving, who are investing. There is another side to the higher interest rate, isn't there?
There is. It's typically old age pensioners who depend on interest rates to earn an income from their savings and their retirement funds. They benefit from these higher interest rates. But typically, the number of people who are hit negatively by higher interest rates versus the number of people who benefit is about 3 to 1. So he didn't mention that. So overall, there are more people who are negatively affected by higher interest rates than the number of people who are positively affected by them.
For those of us who don't have the Dr. Azar Jammine crystal ball, there's always going to be a concern that if we don't get an interest rate hike this time around, which obviously we didn't, if we do get one later, do you think we could get smacked with a big wooden spoon, maybe 50 basis points or 75 basis points because we haven't gone up sort of step by step? We could get a big smack at another point?
I wouldn't be so fearful at the moment. The reality is that interest rates have risen now by nearly 5% over the last 2 years, and they are now at levels that are well above inflation. the repo rate at 8.25%, the inflation rate at 4.8%. That's a 3.2% real interest rate, which is starting to really be quite significant. So relative to the level of inflation, even if inflation goes up to 5.8%, we're still going to have, at the repo rate of 8.25%, it's still quite a bit higher than the prospective inflation rate. And it does not appear at this stage as if inflation is going to run away beyond the next few months. Yes, higher fuel prices are likely to push the inflation rate up closer to the upper end of the inflation target at 6%. I don't think we'll get there, though, because after that, the effects of these high interest rates and the fact that people are taking strain is likely to limit the rate of increase in interest rates that is left. What is clear, however, is that there is a lot of suspicion that interest rates may have to remain at these high levels for much longer than people had previously anticipated, and that it may be 6 to 12 months before we can start looking for the Reserve Bank cutting interest